Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of Unraveling Callable Bonds, everything you need to know about risks and rewards. Prepayment risk. Ever had someone pay you back ahead of time? Sounds great until you consider callable bonds. Prepayment risk is the chance that issuers will redeem their bonds early, typically when interest rates drop. When this happens, investors might have to reinvest their returns at lower rates, which can lead to reduced income over time. It's like renting out your apartment only to have the tenant move out unexpectedly, leaving you searching for another tenant who may not pay as well. This risk is intrinsic to callable bonds and can blindside investors who bank on a bond's full-term returns. If the issuer calls the bond, you're left holding cash that needs a new home, often in a market that's not as favorable. Understanding this risk is crucial. You don't want your expected returns to vanish because of a premature call. Reduced yield potential. The allure of callable bonds often lies in their higher yields compared to non-callable bonds. But keep this in mind. Reduced yield potential is a reality. Why? The callable feature means that when rates drop, issuers jump at the chance to call these bonds to save on interest costs. So, while you might start with a high coupon rate, you face the risk of it being cut short. Imagine working a high-paying job only to have it end suddenly without warning. That's the dilemma here. Issuers redeem the bonds, and you're forced back into the job market, or in this case the bond market, where the rate of return isn't as attractive. You're trading potential yield for the possibility of early redemption. The challenge? You might have to settle for lower-yielding investments if a call happens. Understanding this dynamic helps you decide whether callable bonds align with your investment strategy. Market trends and performance. Navigating the callable bond market can feel like riding a roller coaster with thrilling peaks and unpredictable turns. Understanding how these bonds perform in different economic scenarios is key to making informed decisions. Let's dive into the behavior amid changing interest rates and economic shifts. Callable bonds in a rising rate environment. Callable bonds face an interesting dynamic when interest rates go up. As rates rise, fewer issuers are tempted to call their bonds. Why? Calling the bonds when rates are high means refinancing at a more expensive rate, which issuers tend to avoid. For investors, this can actually be good news. Stable income. The likelihood of the bond being called decreases, providing stable income for the full term. Imagine having a steady paycheck without the fear of sudden job loss. That's what an uncalled bond in a rising rate setting can offer. Reduced call risk. Investors face lower risks of early redemption, which means your investment remains intact. This stability can be appealing if you're looking for predictable returns. Impact on prices. However, as rates rise, bond prices generally fall. Callable bonds are no exception. Investors might see a dip in market value, but the decreased call risk might offset this effect. In a way, higher rates can act as a safety net against the callable nature of these bonds, reducing the anxiety of having to reinvest unexpectedly. Callable bonds during economic downturns. Economic downturns can stir the waters for callable bonds. Investor sentiment tends to shift during these periods, impacting bond performance in several ways. Increased volatility. Economic slumps often bring volatility. Investors may shy away from riskier callable bonds, causing price fluctuations. You might find it similar to the stock market's ups and downs during a recession. It's less predictable, and prices can sway more dramatically. Potential for calls. During downturns, if interest rates fall, issuers might be more inclined to call bonds and refinance at lower rates. It's like a company finding a cheaper rent during a recession. They jump at the chance to cut costs. Investor strategy. In challenging times, investors often seek safer havens. Callable bonds may seem less attractive compared to traditional bonds or other fixed income securities. This shift in preference could influence their market performance, making timing crucial for entry and exit strategies. Economic downturns test the resilience of callable bonds, but savvy investors can capitalize on these periods by understanding the influence of broader market changes on bond performance. Strategies for investing in callable bonds. Investing in callable bonds requires a sharp strategy. These bonds offer a mix of risk and reward, and knowing how to navigate them can lead to smarter financial decisions. Let's explore practical strategies to help you maximize your investment potential. Analyzing callable bond features. Before diving into callable bonds, it's critical to dissect their features. Think of it like buying a car. You wouldn't hand over your money without a test drive. Here's how you can approach this analysis. Examine the call dates and prices. Look at when the issuer can call the bond and at what price. These dates affect your investment timeframe. If a bond has an early call date, you might receive your principal back sooner, affecting your cash flow. Understand the coupon rate. Callable bonds often offer higher coupon rates to compensate for call risks. This rate is your potential income stream. Weigh it against the likelihood of the bond being called. A higher rate might cushion against prepayment risk. Assess credit ratings. Look at the issuer's credit rating. Higher-rated issuers present lower credit risk, but they might call bonds more often when interest rates fall. A lower credit rating might mean higher yield, but also higher risk. Consider call protection. Many callable bonds offer a period during which the bond cannot be called the call protection period. Analyze how long this period lasts, as it provides income security without the fear of early redemption. By fully understanding these features, you're setting a solid foundation for weighing callable bonds against your investment goals. Diversification and portfolio management. Callable bonds can play a pivotal role in diversification. It's a bit like a chef using various ingredients to create a balanced meal. Here's how they fit into your investment menu. Broaden your income sources. Including callable bonds can diversify your fixed income portfolio. They offer high yields that, when not called early, add to your income stream. Mitigate interest rate risk. While callable bonds can be risky, they also reduce exposure to rising interest rates. By blending them with other types of bonds, you can balance the risk and potentially enhance returns. Strategize with laddering. Consider a laddering strategy by purchasing bonds with different maturity dates. This creates a staggered cash flow, minimizing the impact of any single bond being called. Monitor market conditions. Stay vigilant with economic changes. If rates are likely to fall, callable bonds could be called, impacting your strategy. Maintaining awareness allows quick adjustments and helps avoid surprise hits. Diverse portfolios often withstand market volatility better, and callable bonds can be a valuable component in that mix. They offer flexibility, but require a keen eye to ensure they fit seamlessly with your financial objectives. Wrapping up the essentials of callable bonds. In the hustle of investment options, callable bonds stand out with their unique ability to shake up traditional fixed-income strategies. If you're considering these dynamic instruments, remember their dual nature. They offer enticing yields, but with a twist. Their potential for early redemption by issuers brings both opportunities and challenges to your financial game plan. Let's recap what we've covered so far. Key takeaways. Unique characteristics. Callable bonds have distinct features like call dates and call prices, providing issuers the flexibility to manage interest rate changes effectively. Keep these in mind. They can impact your returns significantly. Potential benefits and risks. With higher coupon rates, callable bonds can offer above-average returns, yet they also come with risks like prepayment. Be ready for the possibility of a bond being called when you least expect it. Issuer advantages. Companies use callable bonds as a strategic tool to control borrowing costs and improve financial health. This can mean early calls and an evolving investment landscape for you. Market behavior. Callable bonds react differently to market changes, such as rising interest rates or economic downturns. Knowing how they perform under various conditions helps in planning your investment approach. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like and share to continue your journey to financial success.